Today, we're diving into a really fascinating, kind of mind-bending puzzle at the heart of cryptocurrency. How can a huge surge in demand actually make a digital asset less valuable? I know, it sounds totally backward, right? I mean, Econ 101 tells us that more demand means a higher price, period. But in the wild world of crypto, the rules, well, they can be surprisingly different. So how on earth is this even possible? All right, here's the game plan for how we're going to crack this thing open. We'll start with a real-world puzzle, then we'll get into the core problem, what I like to call the blockchain traffic jam. We'll meet the two groups fighting for space on that jam, and then we'll get to the big idea that solves the paradox, the crowding out effect. After that, we'll see why all this makes prices so crazy volatile, and finally, what it all means for the future. To really understand why this is such a head-scratcher, let's just rewind the clock to a very specific moment in time, the absolute peak of the 2017 cryptomania. Just let that sink in for a second. It is so weird. Just as Bitcoin's price and its popularity were going through the roof, a conference for Bitcoin believers couldn't even use Bitcoin to sell tickets. At the absolute peak of its demand, it basically broke. Now that is the puzzle we need to solve. So, the root of this entire problem, it really comes down to the fundamental design of a lot of blockchains. They have a very, very strict capacity limit. And just look at the sheer scale of this difference. Bitcoin's network can maybe handle about 7 transactions a second. In that exact same second, traditional payment networks like Visa are buzzing through thousands. This isn't just a small gap. This is a massive, fundamental bottleneck. This is honestly the perfect way to picture it. The blockchain isn't some infinite digital cloud. It's much more like a highway, but a highway with only 1 or 2 lanes. So what happens when way too many people try to get on it all at once? You guessed it, a total gridlock. So who exactly are all these drivers trying to merge onto this super crowded highway? Well, it turns out there are 2 completely different kinds of drivers. The economic model we're looking at here basically splits everybody into 2 camps. First, you've got households, or, what we could just call actual users. Their goal is super simple. They just want to use crypto to pay for stuff. For them, crypto is valuable because it's useful. But on the other side, you have the speculators. Their goal is to trade it to make a profit. For them, the value comes from the price going up and down, not from its actual utility. And here is the absolute crucial point. Even though they have completely different reasons for being there, the person trying to buy a coffee and the high-frequency trader trying to make a quick buck, they are both stuck on that same 2-lane highway, fighting for the exact same, very, very limited space. And this intense competition, this is what leads us to the big idea from the research that finally explains our paradox. It's called the crowding out effect. Basically, when a whole wave of speculators rushes in, they jam up the highway. This makes using crypto for actual payments incredibly slow and super expensive. And, of course, if a currency isn't any good for making payments, its fundamental value as money actually goes down. So more demand from speculators leads to less utility, which paradoxically means less value. Let's just walk through this chain reaction step by step. First, hype draws in a flood of speculators. Their trading activity just swamps the network. Then the highway gets totally jammed, causing transaction fees to skyrocket and delays the stretch for hours, sometimes even days. Because of that, the crypto becomes a pretty terrible tool for payments. Remember that Bitcoin conference? And since its usefulness is where its real value comes from, that value takes a hit. And this isn't just a theory. The data backs it up completely. Just look at this chart. The dotted line here, that's all the speculative trading volume. Now, notice how every single time it spikes up, the solid line, that's the average transaction fee, spikes right up along with it. This is the traffic jam, right there in the data. More speculation directly leads to more congestion and higher costs for everybody. Now, this whole crowding out effect doesn't just mess with the fundamental value, it's also a huge reason behind crypto's legendary, insane price volatility. I mean, just look at these numbers for a second. They're pretty wild. The average daily price swing for Bitcoin and Ether is dramatically higher than for huge tech stocks like PayPal or Netflix. Think about that. An average day in crypto is more volatile than some of the craziest, most turbulent days for these other assets. To put it another way, on any given day, major cryptos are more than twice as volatile as major tech stocks. So the big question is, why? Why all the drama? Well, the paper argues that it's because all this congestion makes success a much riskier bet.
When the network is constantly clogged, the odds that the cryptocurrency will ever really succeed as a functional, everyday form of money get a lot longer. This uncertainty basically turns investing in it into a high-stakes lottery. There are really only two outcomes. It either works and becomes incredibly valuable, or it fails and it's worth nothing. And the higher the odds are against winning, the more volatile the price of that lottery ticket becomes.
So, with this fundamental tension baked right into the system, what does the future actually hold for cryptocurrencies as a form of payment? And this brings us to yet another fascinating paradox, the digital gold effect. The more valuable a crypto becomes, the more painful it is for a regular user to spend a chunk of it on high transaction fees. So what do? They'd rather just hoard it, hoping its value goes up even more. So as the price rises, the willingness to actually use it as money can go down, which creates this self-reinforcing cycle. So is there a fix? Is there a way out of this traffic jam? Well, there are a couple of promising ideas floating around. One is to move all that speculative trading off-chain by using financial tools that let people bet on the price without actually clogging up the blockchain itself. Another is to build what are called secondary payment layers, like the Lightning Network, which basically act like express lanes for small, everyday payments, leaving the main highway clear for bigger, more important transactions. All of this really leads us to one fundamental question. Given these weird dynamics of congestion and value, is crypto just destined to be a scarce digital commodity like gold, something you hold on to, rather than a fluid digital currency, something you actually spend? That tension right there, between being a store of value and a medium of exchange, that is the central puzzle that the future of crypto really depends on solving.